Hi friends, welcome back. Hope you all are enjoying my videos. Today I would like to give you the summary of The Intelligent Investor. The Intelligent Investor was written by Benjamin Graham in 1949. It is possibly the most important and influential value investing book ever written. We can say this a Bible for all investors. Warren Buffett described it as by far the best book ever written on investing. It made the concept of investing simple and easy to understand, so any individual can become an intelligent investor. Are you an intelligent investor? Don't worry, let's get into the video and see what Ben has written about this book. Here the intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined and eager to learn. You must also be able to harness your emotions and think for yourself. Sir Isaac Newton was one of the most intelligent people who ever lived, as most of us would define intelligence. But in Graham's term, Newton was far from an intelligent investor. In 1720, Newton owned shares in the South Sea Company, the hottest stock in England. Sensing that market was getting out of hand and bought at high price and incurred a huge loss of 20,000 euros. 20,000 euros was a very big amount in 1700. So, high IQ and higher education are not enough to make an investor intelligent. The first step towards being an intelligent investor is understanding the difference between investing and speculating. Investing is a thorough analysis of an investment that includes determining the characteristics of risk or return of the asset and can promise the safety of principal amount and an adequate return. Speculations, on the other hand, refers to taking investment decisions that are not made on the foundation of research and analysis. This can consequently lead to high probability of losing capital. The speculator's main interest is to anticipate and profit from the fluctuations in the market. Ben suggests that money in the speculation account should never be mixed with the money in the investment account. The investor should limit their allocation to speculative position to not more than 10% of the investment if they wish to speculate. And he recommends to have a separate account for this, and he calls speculative account as mad money account. So what are the elements we need to consider while investing? The intelligent investor will never exit a stock position purely in response to the share price movement. They will first ask whether the value of the company's underlying business has changed. They like to keep an eye on the fundamentals of the company like cash flow, profit and loss, overall sales and so on. The investor's primary interest is to acquire and hold suitable securities at suitable prices. Investing is not about beating others at their game. It's about controlling yourself at your own game. Most investors fail because they pay too much attention to what the stock market is doing currently. This book is also famous for introducing two concepts into the investing profession: the fictional character called Mr. Market and the concept of margin of safety. Now let us understand who Mr. Market is and what he does. I will explain Mr. Market concept with an analogy. It is a hypothetical scenario in which you have a mad partner in a private business. Some days your partner is very happy and he values his stake very highly, much more than its likely worth. Other days he is very sad and he is willing to sell his stake for much less than it is likely worth. Here Ben's point is that rather than let the crazy Mr. Market tell you what you should think the value of stock is, you should instead just take advantage of his rationality by buying him out when he is valuing his own stake way too low and selling to him when he is valuing the business way too high. Mr. Market teaches that although price fluctuate, it is important to look at the big picture, that is fundamentals, rather than reacting to temporary emotional responses. So, recognizing the actions of Mr. Market can help investors make wiser stock choices. Next, we will see what the margin of safety is and why it is important. Margin of safety is the difference between the intrinsic value of the company and the price we pay to purchase it. The amount of price paid is the most important factor in investment. In general, we all think that high price stocks are good for investment, but price and value are two different concepts. Determine the purchase price, and having the discipline to only buy at a below the price is where the true test lies. So, how do we calculate the intrinsic value of a stock? There are several methods, and let me highlight the three important ones. First, discounted cash flow analysis. Some economists think that discounted cash flow (DCF) analysis is the most accurate way to calculate the intrinsic value of a stock. Here, you will probably need to delve into the financial statement of the business. You need to follow 3 steps. First, estimate the company's future cash flows. Second, calculate the present value of each of these future cash flows. Third, sum up the present values to obtain the intrinsic value of the stock. Here is the formula, and there are a lot of study materials on this. Please read through to understand better. Second method, financial metric. A quick and easy way of determining the intrinsic value of a stock is to use a financial metric such as the price to earnings (PE) ratio. Here is the formula for this approach using the PE ratio of a stock. Final one, asset based valuation. The simplest way of calculating the intrinsic value of a stock is to use an asset based valuation. The formula for this calculation is simple. Sum of a company's assets, both tangible and intangible, minus sum of a company's liabilities. There are a lot of other methods to calculate intrinsic value. Knowing all of them is very helpful. Moneycontrol.com and other financial related websites have a lot of case studies. Next, let us go to the next topic. Investors are of two main types, the enterprising investor and the defensive investor. In a defensive investment strategy, investors aim to protect their capital from losses, generate decent returns, and minimize frequent decisions. Part-time investors should stick to defensive investment strategies. These investors can achieve decent results with minimal effort and capability. On the other hand, enterprising investors devote most of their time to managing their portfolios actively. They have the time and experience or proper guidance in investing to expand the possible universe of opportunities beyond conservative investments. Let's move to the important segment of this video, that is stock selection criteria. There are few tips. Let us go one by one. First, check the size of the company. Exclude small companies that are more volatile. Second, long-term prospects of the company. Gather evidence in the financial statements that answers two questions. What makes this company grow? Where do its profits come from? Look for these companies. Choose sufficiently strong financial condition. Current assets should be at least twice the current liabilities, and long-term debt should not be more than net current assets. Fourth, prefer to run marathons, not sprints, so hold it for long term. Fifth, check the dividend history. It should be consistent dividend paying company. Sixth, earning stability and growth. Check for consistent earning capacity and growth. Next, price of the stock should be less than 120% of net tangible assets. 8. Do not be swayed by home bias. Many average investors make the mistake of buying familiar stocks or known stocks to them. A bear market is a much safer time to buy stocks close to their asset value and build sustainable wealth. Index funds are most reliable long-term bet for defensive investors. 10th and most important one, diversification. A diversified portfolio has a higher probability of generating above average returns. So that's all about this book. Adopt an evidence-based approach to invest. Do not fall in any trap of false recommendation from any advisors. This week I would recommend My Experiment with Truth, which is an autobiography of Mahatma Gandhi. This book gives 5 elements. 1. His childhood days. 2. His experience in South Africa where he has experimented a powerful weapon called Satyagraha. 3. His transformation from Mohan to Mahatma. 4th, his main philosophy Satyameva Jayate. 5th, his non-violent struggle in South Africa and in India. So that's all about today. See you in my next video. Bye.